Nowadays, with the stock market going crazy and a bunch of stocks hitting record highs like Apple, Amazon, etc., this has brought renewed interest to investing. Unfortunately, this is not as easy as saying buy all the stocks, buy all of them. Given the current climate, there are some things you can do as an investor to profit from the manic that the market is in. Just like with most things in life, investing is a lot easier said than done. There's a lot of uncertainty in the coming months with regards to what the Fed will do and whether everything will go back to normal as lockdowns are released. So in this video, I'll talk about a few investing mistakes that beginner investors make. If we do see another stock market crash, then it can be a golden opportunity, possibly once in a lifetime chance to buy investments on sale. There's going to be a lot of volatility in the stock market in the coming months. And so, as you put your investing game plan together, here are the top mistakes to avoid. But just before we begin, my channel is all about money and investing for beginners, and I know it's going to help you learn a lot. So hit that subscribe button. The number one mistake that beginner investors make is investing before they are ready. First, never invest until you're fully ready to, and that means financially and mentally. Pay off your high interest debt before you start investing. If you are deep in debt and paying say like 20% interest annually, which is not an unusual rate, any money you spend on stocks would have to earn more than 20% just to keep you from losing ground. Over long periods of time, the stock market's annual returns have averaged close to maybe 10%, but definitely not 20%, with many periods featuring significantly less than that. So let's say you pay off your high interest debt today that you're paying 20% interest on. As soon as you do that, you've just made 20% on your investment because you've saved yourself from paying a very high interest rate. On the other hand, if you had invested your money in the stock market, there's no guarantee of a return, but you will still pay the high interest with your debt. It's also smart to have a fully stocked emergency fund in place before you start putting money in stocks. Aim to have at least 6 to 12 months of living expenses easily available. Without an emergency fund, a costly car repair or unexpected medical bill can force you to sell your stocks at a bad time, such as when they have temporarily fallen in value, causing you to lose out on your future gains. Number two is not investing at all. This is by far the most common mistake I see beginner investors make, and it's completely understandable. After paying off your debts and having a good emergency fund in place, it feels a lot safer to have the money just build up in a savings account rather than actually investing. It gives this sense of financial and emotional security, and you should also keep some money in the bank, i.e. in the form of an emergency fund and for day-to-day expenses. But past that, it doesn't make any sense to just hoard cash. And over time, money loses its value due to inflation. So you may have heard the word inflation being thrown around a lot in the media and in the news. And what it simply means is that it's a sustained increase in the value of goods and services over a period of time. Now think of it this way. You go out and you buy a brand new car for £40,000, dollars, whatever. Now as soon as that car hits the road, it decreases in value, even though it's exactly the same car and not much has changed. It has fallen in value. Just like that, the value of your money will fall over time. Means its purchasing power, i.e. its ability to acquire the same goods and services, will decrease. So for example, in the 70s, the cost of coffee was around 25 cents. But now in 2020, it's closer to $1.60. And if you're going to Starbucks, that's a heck of a lot more. And this is why you need to invest rather than just keep cash in the bank. There are so many people who just keep their cash in the bank for a very long period of time and possibly their whole life. And currently banks are offering rock bottom interest rates and the inflation is far higher than these. And as such, your money is losing value, but by investing your money in the stock market, for example, over a reasonable period of time, you're fighting the inflation plus making something on top. And that's how you grow your wealth. On the other hand, if you don't invest your money, then over the next 30 years at an inflation rate of say 2%, your money will lose half its value, and that's just due to inflation. Which means if I have the same amount of money I had 30 years ago, then everything today would be twice as more expensive for me, which means it's harder to pay for things and maintain the same standard of living. So money in the bank creates an illusion of safety. But if your money does not grow faster than the rate of inflation, then you're not even keeping up, but you're actually falling, a little bit like trying to climb an escalator that's going down. That's why saving money isn't just going to cut it. Investing is your only option at beating inflation. Yes, it's understandable there are a lot of hurdles, especially emotional hurdles like the volatility of the stock market, which we have been seeing for the past few months. The stock market can feel like a bloodbath. However, I'm willing to put up with those ups and downs and hold on, because the alternative is simply not a viable option. If you haven't invested before, it's going to feel quite scary to get started with, no matter what the stock market is doing. So the emotional experience of losing your hard-earned money isn't going to go away. So I want you to stop making excuses, stop procrastinating making decisions that you know you need to make, and make a plan. Do your research and get your money invested. And if you're looking for some advice, then check out my videos which are linked up here on how to get started investing in the stock market and other stock market basics. So moving right along, number 3. Setting unrealistic expectations. Building wealth through the stock market can take time, and dreams of quick gains can be quickly dashed. Never put any money into stocks that you may need within the next 5 years, because this market occasionally swoops and can take a few years to recover. Have reasonable expectations when it comes to stock market investing. For instance, the market's long-term average annual return is close to 10%. But some years it can surge to 25% or more, while it can drop by 25% or more in some years. Expect volatility and know that few stocks will deliver long-term average returns of more than 20%. Investing will not make you filthy rich overnight. It takes time, and if you're expecting to make Lambo kind of money overnight, then this isn't something for you. By investing, you're allowing your money to compound over time, and that takes time. Number 4. Trusting the wrong people or sources. Many new investors put too much faith in talking heads on financial TV programs or in hot stock tips offered by various people in their lives. Anyone can recommend a stock, but you rarely really know the track record of the recommender. And even a great investor will make some bad calls. Just look at Warren Buffett, for example, who is widely regarded as the most successful investor of all time, made a bad call on airline stocks and lost out billions of dollars. Investors can also be fleeced by cold callers who interrupt an evening with an urgent appeal to put money into one-of-a-kind, can't-lose investment, perhaps a company supposedly on the verge of curing cancer or striking gold or oil. Remember, anything that sounds too good to be true most likely is. Where we desperately need or want to change, we often disregard all the outward and inward signs that indicate if a person should be trusted. Instead, we go with what sounds wonderful and impressive, and what we think will get us out of our current pain and challenge as quickly as possible. Even if we know what this person is offering feels too good to be true, we jump at it because we want to believe there's a quick, easy way out of where we are today. Moving right along, the next biggest mistake investors make is buying and selling investments they don't understand. You're probably aware that Amazon.com is a massive e-commerce site, and you probably are also aware that it sells devices such as the Alexa, which uses Amazon's artificial intelligence technology. But what you might not know is that Amazon's fastest growing division is actually in cloud computing services, or that it's developing a game streaming service, or that it's planning to open 3,000 cashier-free convenience stores around the US. If you invest in Amazon or any other company, you really need to have a good handle on exactly how it makes its money, what its competitive advantages and risks are, how financially healthy it is in terms of cash versus debt, and how rosy its future seems to be. Do not invest in anything that you do not understand, and if you do, it can end up in disaster. The next mistake I see new investors make is waiting too long to get in. Once you've paid off your debts and have an emergency fund in place, apart from your mortgage, if you have one that is, you're ready to start investing. Often I see beginner investors get ready investing, if that makes sense. As mentioned before, it is scary to start investing, but at some point you will have to pull the trigger. You can wait and wait and wait till it's the perfect time to get into the market, but there's never going to be the perfect time to get into the market. Well, theoretically, the best time to get in the market is at the bottom of a crash. No one knows when the market has bottomed out until after we've passed it. So basically, it's until it's too late. As the saying goes, Hindsight is 20/20. But if you're a long-term investor, then timing the market is not a really good use of your time. I know it can be thrilling to try and predict the market tops and bottoms so that you can make perfect decisions and you don't have to watch your portfolio go up and down, but that approach will have you waiting for a really long time. And let's just say that you somehow manage to predict when the market will crash. Will you be able to buy then? Because market crashes are a scary time. A lot of investors get scared and then they buy and sell out of their emotions and then they lose out. It can be an absolute bloodbath. So don't wait too long to start. If your finances are reasonably stable, you're ready now. Then go right ahead and start investing. Now that doesn't mean you should invest all your life savings in the stock market, which brings me on to the next mistake, investing too much money at once. As a beginner, investing takes time, and it makes sense to start investing with small sums of money in the stock market. This is so that your nerves can get used to the frequent fluctuations that occur pretty much every second in the stock market. Watching your $100,000 or pound portfolio rise and fall in value can feel very different from watching a £1,000 investment fluctuate in value. So when it comes to investing, don't follow what Iron Man aka Tony Stark says.
Jarvis, sometimes you gotta run before you can walk. Ready?
Instead, don't run before you can walk. Invest small amounts of money that you're comfortable with and see how it feels. And if you can tolerate that and are not lying in bed awake at night stressed about it, then you're ready to invest more amounts of money and see how that goes. Taking baby steps is the key. If you try investing too much at once, it may be a little bit of a shock to your system, and then you may do something stupid like panic sell when your investments tank in value. You weren't expecting that at all. Remember, markets will crash from time to time and they will fluctuate in value, and panic selling is never a good idea. Especially selling after a crash is also never a good idea, and this can put you off from investing altogether. Right, we've talked about how to start small and train your nerves, but remember, you will need to ramp up eventually, because the next beginner mistake is not investing enough money to cover your future financial needs. According to statistics, 16% of pensioners in the UK will live in poverty. That's nearly 2 million people. And worryingly, this number has started to grow in recent years. In the US, 40% of Americans will fall into poverty or near poverty in retirement. And I'm not trying to scare you, but I don't want you to become another statistic either. So how much do you really need to save for retirement? So for example, let's say you want to retire in 15 years, whether that's early retirement or you're retiring at the age of 65. Let's say you want to have $50,000 a year to live off in 15 years when adjusted for inflation. So that would come to something like $67,000. That could be dollars, pounds, whatever. Which means your investments in 15 years need to provide you an income of $67,000 15 years from now. That's $67,000 per year. If we follow the 4% rule, your total investment pot, also called the next egg, needs to be around 1.68 million. It's a rule of thumb that says you can withdraw 4% of your portfolio value each year in retirement without incurring a substantial risk of running out of money. But this amount can be considerably less, as you may have other sources of income such as state pension or social security, or you may choose to sell your existing home and downgrade to a smaller home as your kids move out, etc. Now let's say you need to get to $1 million in investments, assuming the remaining $680,000 will come from other sources such as social security or state pension. So get to $1 million or pounds or whatever, you will need to invest something like $4,100 a month at an average return of 8% a year. And I know that sounds like a lot, and it's huge. Most people don't earn that much before tax. If you start investing when you're 25 years old and you want to retire at 65, you only need to invest time really matters. This is all due to the fact that you're allowing your money to compound over time. Your money is working for you. So I hope you found this useful. Let me know what your thoughts are in the comments below, and I'll see you in the next video. Thanks a lot for watching, and see you next time.